Gold has smashed through historical price barriers. It hit a new record high in early 2025, surging past $2,800 per ounce. This represents a remarkable gain, up over 27% from the previous year. This is the largest annual increase in over a decade. Investors are carefully watching gold's performance. Some analysts believe this is just the beginning, predicting even higher prices in the near future. Others are more cautious, pointing to potential factors that could moderate gold's trajectory. One thing is certain, gold's performance in 2025 has captured the world's attention. The reasons behind gold's remarkable ascent are complex and interconnected. Global events play a significant role in shaping market sentiment. Economic uncertainty is a key driver of gold prices. When investors feel uncertain about the future, they often turn to gold as a safe haven. Gold is seen as a tangible asset with intrinsic value and has a long history as a store of wealth, making it an attractive option during times of economic turmoil. However, predicting gold's future price movements remains a challenging endeavor. The market is influenced by a multitude of factors, which can shift rapidly and unexpectedly. Geopolitical events, economic data releases, and central bank policies can all impact gold prices. As a result, investors and analysts closely monitor global developments to anticipate how these events might affect the precious metals price trajectory. The recent surge in gold prices has sparked debate among experts. Some believe that this is the start of a new bull market for gold, arguing that the factors driving gold's rise are structural and likely to persist. Others are more cautious, suggesting that the current price surge could be a bubble, pointing to historical precedents where gold prices experienced rapid increases followed by sharp corrections. Only time will tell what the future holds for gold. However, one thing is certain, the yellow metal continues to fascinate and intrigue investors around the world. Global trade tensions are a major source of uncertainty, and these tensions have escalated in recent years. Trade disputes have erupted between major economies, with the United States imposing tariffs on goods from several countries. These tariffs are designed to protect domestic industries but have also sparked retaliatory measures from trading partners. China, in particular, has responded with its own tariffs on U.S. goods. This tit-for-tat escalation of tariffs has created a climate of uncertainty. Businesses are hesitant to make long-term investment decisions, unsure about future trade policies and the potential impact on their operations. Consumers are also feeling the pinch, as tariffs have led to higher prices for imported goods, putting upward pressure on inflation in some countries. Geopolitical risks further exacerbate market anxiety. Tensions between global powers remain elevated, with regional conflicts and political instability adding to the sense of unease. The situation in Ukraine is a case in point. The ongoing conflict there has sent shockwaves through global markets. Investors are concerned about the potential for wider conflict and the impact on the global economy. In such a climate of uncertainty, investors often seek refuge in safe haven assets. Gold is traditionally viewed as a safe haven, as it tends to hold its value during times of economic or political turmoil. Unlike paper currencies, gold is not subject to the whims of central banks and cannot be printed at will. This gives it an intrinsic value that is not tied to any particular government or economy. As a result, demand for gold often rises during periods of heightened uncertainty, as investors view it as a way to preserve their wealth and hedge against potential losses in other asset classes. Central banks around the world have responded to economic challenges with monetary easing, which involves lowering interest rates to stimulate economic growth. Lower interest rates make it cheaper for businesses to borrow money, encouraging investment and spending. However, lower interest rates also make holding gold more attractive. Gold does not pay interest like bonds or savings accounts. When interest rates are high, the opportunity cost of holding gold is higher, as investors can earn a decent return by keeping their money in interest-bearing assets. However, when interest rates are low or even negative, the opportunity cost of holding gold diminishes. Investors may choose to hold gold as a store of value, even if it does not generate any interest income. The Federal Reserve, the central bank of the United States, has been particularly aggressive in its monetary easing policies. It has slashed interest rates to near zero and pumped trillions of dollars into the financial system through quantitative easing programs. These actions have flooded the market with liquidity, making investors more willing to invest in assets like gold, which are seen as a hedge against inflation. The impact of monetary policy on gold prices is not always straightforward. Other factors, such as economic growth and inflation expectations, also play a role. However, in general, loose monetary policy tends to be supportive of gold prices. When central banks keep interest rates low and inject liquidity into the system, it creates an environment where gold is more likely to appreciate in value. This is why many analysts believe that the current environment of low interest rates and quantitative easing is bullish for gold. Inflation concerns are another factor driving investors towards gold. Inflation erodes the purchasing power of money over time. When prices rise, it takes more money to buy the same goods and services. This can be particularly problematic for individuals and businesses on fixed incomes, as they see their purchasing power dwindle as prices rise. Gold is often seen as a hedge against inflation. Unlike paper currencies, which can be printed in unlimited quantities by central banks, the supply of gold is relatively limited. This limited supply makes it difficult for governments to manipulate its value through monetary policy. As a result, gold is often seen as a more reliable store of value during periods of high inflation. Investors buy gold as a way to preserve their wealth and protect themselves from the erosive effects of rising prices. The current global economic landscape is characterized by a confluence of factors that are supportive of gold prices. Trade tensions, geopolitical uncertainty, and accommodative monetary policies have all contributed to the yellow metal's recent surge. While it is impossible to predict with certainty where gold prices will go in the future, the current environment suggests that the precious metal is likely to remain an attractive investment for those seeking a safe haven in uncertain times. Gold has been a store of value for centuries. It has weathered countless economic storms and political upheavals. Its enduring appeal lies in its intrinsic value, its limited supply, and its ability to hold its value during times of crisis. While gold prices can be volatile in the short term, over the long term, the yellow metal has consistently proven to be a reliable store of wealth. As the world navigates an increasingly uncertain future, it is likely that gold will continue to play an important role in investment portfolios around the globe.